I wanted to go into this thread that Preston posted this week. I loved it. It got me all fired up. It was just a really great way to present this data. It was a very effective way to present this data. It was like one punch landing after the other, and then it was just like this final little like death blow at the end. And I hadn't gotten so excited about a thread for a little while, so I'm gonna share my screen, and let's just talk through this. I know Andy will have some commentary on it too.
Okay, so in general, I was trying to just model all of the market cap for equities across the whole globe, and it's a little tricky to do. And so I was just going through it, and I was like, all right, so I got to make sure that these are weighted. And whenever I'm looking at all the different indexes on one chart, the thing that I didn't like about it was the weighting. So like you're seeing maybe India blow out and it's just booming, right? And well, that's just such a small market. I think it's only like 2 to 3% of the overall global economy is that market cap, right? And so I wanted to weight it, and whenever I weighted it all and I compressed it into a single line, what I was really trying to understand is, are we starting to see a cap? Or are we starting to see a top in equities from a global perspective? And the reason why I was trying to understand that is because I'm looking at the U.S. It's still booming. It looks like it's starting to roll over a little bit. And now that the fixed income market's starting to tighten, you're starting to see the Fed say that they're going to even, start to tighten the federal funds rate. I'm thinking, okay, this might be getting very toppy, but I wanted to see it from a global perspective because maybe Europe, maybe Japan, maybe China are already selling off in a more aggressive way because those are the main ones that are really kind of driving the global economy outside the U.S. And so I just wanted to consolidate it all into a single line. And so when I did that and I saw my thesis and what I was expecting is that we were kind of topping out was true. And scroll down just a little bit more. Scroll down one. Yeah, keep going. One more.
Yeah.
One more. This one right here.
There we go.
That one. So when you look at that chart right there, you can see that it's really starting to look like a top from a global perspective. And so I was just like, let me just readjust this for M2. And I was just kind of curious what it would look like. And if you go to the next one down from there, it was kind of insane what I saw. And I was like, holy hell, from the bottom of the 2009 crash, and I'm talking the bottom, not the top, we are completely flat from that period of time when you readjust the global equity index against M2. I'm just thinking, oh my God, this is crazy, right? And I wanted to present it because what everyone sees is that first chart, which is the NASDAQ or whatever local stock index that they're accustomed to in their country, and it's just going straight up. It's going parabolic. Yep. But whenever you adjust it for all these other things, you're literally flat from the bottom of 2009. And I was just like, this is crazy, right? Absolutely. So I tried to lay it out in a thread that kind of like walked the reader through my discovery process of like how I was trying to solve the puzzle of kind of like understanding where we're at in space and time. And what I found and what I discovered, even for myself, I remember sitting there looking at the chart and I said, oh my God, this is crazy.
That's the same experience I had.
Yeah, this is wild.
Yeah, for those of you listening over on Spaces, we're going to try to throw it up into the nest. If not now, then when we come over for the Q&A, and on the podcast, it'll be in the show notes. But definitely go through the thread. And Preston cooked up these charts, and it's very impactful. A chart, speaks 1,000 words for sure. And then of course the kind of closing salvo is let's take a look at how this affects the bottom line, the real world, right?
And this is one of my favorite things that Michael Saylor has really kind of introduced to the community, is this idea of inflation being a vector. And so when you're adding all these units into the system, where are they ending up, right? And who has the first cut of selecting where they go next? And when you walk through that process and you realize how much quantitative easing has been used over the last decade, you quickly realize that where all these fiat units that are being added into the system are ending up, they're ending up straight into assets. And it's just when you walk the dog and you follow the path of how these units are going, they're going in bidding asset prices. Now, whenever that happens, what's taking place is you're clawing that out of the hands that was somewhat distributed 10 years ago. And 10 years before that, it was even more distributed amongst the population. But as you continue to exercise these policies, what you're doing is you're just polarizing the ownership of anything that's equity-based and debt-based straight into the hands of the few. And, it's making it harder and harder for everybody else. And so when you're looking at like the velocity of money, a lot of people hate that term velocity of money. But when you look at that and you look how it just keeps going down, that's why, is because they're having difficulty adding units into the system and it actually trickling down into the populace. Instead, it's just going into the hands of the few, and they're just, okay, well, I'll just buy more equity, which will generate more cash flow for me, and it'll generate higher market caps, and I'll go out and buy another 3 yachts, I guess. I mean, at what point, how many yachts can you buy before you just say, you know what, I'll just buy more stock in Apple or whatever?
It's such a monumental crime. It's fixing on the grandest scale possible, fixing a game. Let's take a quick break there. That was fantastic. Hold on, I didn't give Andy a chance to weigh in on
yeah. I mean, it's a really sobering analysis that Preston has presented here, and I guess my thoughts are, one, not only is it clearly the Fed's, not only clearly is the Fed exacerbating wealth inequality, making the rich richer, but they're denying it as they go. And that they recently, announced some social or ESG mandate. I can't remember the exact, statement, but it was like, basically they were saying, we're here to help with this, equity problem or social problem. And it's like, no, guys, if you want to help, like, stop printing money, stop it with the QE.
Right.
and let the zombies die.
Yes,
right?
let the zombies die.
You gotta let the zombies die.
Yeah. And the other thing it brought to mind too is, when you look at where value has accumulated in the last decade, if the total, as Preston points out with those data, if the total trend versus M2 is flat or down, then what does that mean? Well, it means while the S&P and specifically the NASDAQ and the tech and software sector have made attractive returns, it means everything else has been, crap, right? It means everything else is going down in relative terms, or in, I don't want to say absolute terms, but maybe like absolute, monetary base adjusted terms. And it reminds me of a conversation I had with a fund manager that some of my clients are invested in. And a few years ago, I sort of prodded him. I asked him the question, and the question to him was like, what if Mark Andreessen is completely right and software eats the world? And what if literally every dollar or more than every dollar of market cap creation just accrues to software, right? Like if the overall, stock market goes up by X%, or let's say the S&P goes up by X% over a period of years, what if all that gain accrues to the big software guys? And so far lately, it kind of looks like that's playing out. And partly that's a US story, right? Like obviously the biggest internet giants and software giants are US based, which tells you a little bit about why the NASDAQ and the S&P have outperformed compared to foreign markets, which have been really disappointing for the last decade. But yeah, it just puts that all in perspective, and it does make me worry that everybody feels richer, right? Because these asset prices, at least in the U.S., are going up, and yet when you adjust it to the monetary base, as Preston points out, it doesn't look that great.